Okay, good morning and happy Friday, everyone. Welcome back to our Friday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we have quite a bit to unpack as far as where the current market is trading, what we're looking at in terms of how do you go about continuing to take on long positions in this type of market, and how do you think about whether or not we're going to get a bit of a pullback here. So a lot to cover. Before I do, just a quick disclaimer: what we're going to discuss here today is purely for demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's first off by taking a look at the overall market. As we do, let's do a quick market update. The markets are now almost less than 15% from its all-time high, around 313 or so. That certainly puts us in a very strong position here. Let me get my mouse cursor working here. We've had this subsequent rally, but the market has now broken back above its 20-week moving average, which certainly puts us in a substantially more bullish position. The daily chart, we've been talking about this for quite a few weeks now, where we've kind of battled it out around this 284 level. But just on Monday, we started to break out higher above this range, mostly on optimism around vaccines to cure coronavirus, the Fed stepping in, or the language from the Fed saying that they will continue to, whoops, cannot see my screen. Sorry, can you guys see my screen now? Okay, perfect. So as I was saying before, weekly chart, the stock markets have managed to reclaim the 20-week moving average, which puts us in a substantially more bullish position here for the S&P 500. We'll talk a little bit about why we're seeing such strong gains from the equity markets despite the economic numbers that we're currently looking at. But from a daily chart perspective, one of the things that we continue to see is the fact that as the markets continue to grind higher, which predominantly has been around this 285 level, one of the things is that momentum has stayed flat this entire time. We had a small breakout earlier this week on Monday on optimism around having a vaccine later this year, the Fed's language over the weekend regarding what they will do to continue to step into this market and support the market, even if there is some type of another sell-off, whether it's related to a second wave of coronavirus or the other risks that we currently see with respect to US and China. Whatever those concerns might be with the markets, the Fed has kind of eased those concerns by stepping in and saying that they will continue to step in. And that's provided a huge support here for the markets. But right now, we've traded back a little bit into this zone here. We're still above that 20-day moving average. We're starting to peak a little higher, but as I said, momentum continues to remain flat here. So it's not really confirming these highs. Money flow also remains fairly weak here, or very weak rather, on these subsequent rallies. So today we're going to discuss a few things. We're going to discuss, number one, the fact that the markets are trading, where the markets are trading, and provide some thesis or ways to think about whether or not the markets are overbought, whether the markets are expensive or cheap, and kind of look at it from a few different ways, because I think depending on how you're looking at it, you could make a case for equities being actually relatively cheap, even though from a valuations perspective, we are talking about fairly expensive valuations compared to history. Now, this market is predominantly at the moment driven actually by consumer discretionary leadership. So tech has kind of pulled back a little bit over the last couple of days. Consumer discretionary continues to push new highs. One of the things I will say is that momentum hasn't really been confirming these new highs. So be very careful, but it is well above the 20-week moving average, while the equity markets are just getting back above the 20-week moving average. Consumer discretionary, healthcare, and technology are the only sectors right now that are substantially higher, and looks like they're about to break out and continue moving higher. So we're going to look at a few names here in this particular sector today, but one of the sectors to really pay attention to. The other thing that we pointed out on Tuesday, and it's still continuing to happen, is that this leadership is starting to broaden out. Originally, as far as the rally goes, it was predominantly across the mega cap names that were rallying and leaving a lot of the small caps behind. But we're starting to see life come out of the small caps. Small caps actually still positive the last few days while the markets were down slightly. So we're starting to see this leadership broaden out, and small caps is now testing the 20-week moving average. If it breaks above it, it certainly has quite a bit of room up to around that 148 level, which is roughly around right here. So we're looking for that breakout and potentially move higher here on IWM, or the Russell 2000 index. So those are some of the things to pay attention to. This is all supportive of equity markets continuing to rally. I know there's a lot of concerns and a lot of people saying that they feel that the markets are ready for a pullback, but the evidence at the moment still suggests that this rally is being supported, and there's further support for a continuation of this rally, as crazy as that may seem. Now, volatility, I do want to take a look at VIX as well. VIX, over the last couple of days, for quite some time, has been continuing to grind lower lows, higher lows. But over the last couple of days, we really started to see a bit of a bottoming formation here in VIX. It is right now trading below 30. It's trading just below 30 right now, but it does seem to have paused a little bit on that decline. We want to see a new push low below 25 to be really bullish here on the market. So I think the markets right now are a little bit uneasy around that 30 level. Right now, we're really paying attention here to the VIX. 3-month VIX trading at 32. So VIX can very quickly push back into backwardation, put us back into a risk-off environment. So it is very much near equilibrium at the moment as far as risk on, risk off. So it's something that we want to pay attention to very closely as to whether front month VIX or the 1-month VIX actually gets to becomes higher than the 3-month VIX, telling us that the markets are a little fearful, if you will, of the market. So that's a little bit of an update here on volatility. So let's take a look at what we're currently looking at today. So right now, what we really want to take a look at is whether or not markets are going to retest 300 to 302 on SPY. That's my current base case at the moment, is that you're going to get a little bit of a sell-off, bleed off some of this momentum over the next couple of days, but eventually you're going to continue to grind higher. We've traded at the top of the range between looking at the different sectors, between looking at IWM and small caps rallying. This is all supportive of this market continue to move higher. If you look at LQD, if you look at HYG, the bond market's also rallying along with this. So there's a lot of support, and partially this is the Fed buying these ETFs, providing a continuing support for equities here in this particular market. So that's our base case, is that we're going to retest 300, 302. Perhaps if we break above 300, 302, that puts us in a substantially different bullish position. But at the moment, that's our base case. There might be a little bit of a sell-off on our way to 300, 302, but I feel that we're going to tag that level in the next few weeks. Now, as I said, VIX currently hovering around 30, which is not continuing to move lower just yet. If VIX can get below 25, that puts us in a substantially more bullish position. Oil did get rejected at 35. So this might mean that we found a little bit of an equilibrium here on oil prices, which may put a cap on energy stocks. So if you were long energy over the last few weeks, which have been the strongest sector for a couple of weeks now, this might be a time to start taking profits on those types of trades, unless oil can get back above 35. But if we look at demand right now, it doesn't seem that way, but that's a level to keep an eye out on. Liquidity continues to improve. It's actually quite good now, 319 very liquid option symbols. Again, for those of you that are new to OptionsPlay, you can find that within your OptionsPlay platform at the bottom of your platform, with a link here at the bottom for earnings, and I'll show you here that in 1 second as far as how to access that. But when you log into your OptionsPlay platform, you will see a link at the bottom of your screen for liquidity and earnings, and that will show you the number of liquid optionable symbols. Like I said, right now, roughly a little over 300 names, 319 names that are what we consider very liquid right now. During the sell-off, there was only 55 names. It grew to 100, 180, and hovered around 180 for quite some time. Now we've expanded out to 300. So you have a lot of names that you can trade options on right now, where you have a fair amount of liquidity. So this is all, again, supportive of moves higher here in the markets. Now, what I want to do is I want to talk a little bit about the data that we're currently seeing as far as states that are reopening their economies, how we're seeing consumer spending shift in those types of economies, what type of uptick are we seeing in terms of the data. And also take a look at, whether or not we actually think equities are cheap or expensive, because by many ways of measuring valuations, things are quite expensive, but they're nowhere near recent peaks such as the dot-com bubble, financial crisis. So we're not at that euphoric rate where many times we see markets sell off substantially from. And that's again why we have this base case that we believe markets are going to continue to grind higher for some time until we might reach some of those peak valuations, and maybe even exceed those peak valuations before we see some kind of sell off. And some of the data that we're currently looking at also speaks to a little bit as far as how long we think we're going to be affected by COVID-19, even though some of these states are starting to reopen. And then what we're going to take a look at is really kind of how do you position yourself? What stocks do you want to be positioned within the markets for this subsequent rally that we are expecting here in this market? So those are some things we're going to discuss. First of all, let's on the topic of cheap or expensive. Now, I don't think I really need to speak to which metrics show us that markets are are not overvalued, that markets are quite expensive, whether you're looking at PE ratios, whether you're looking at different types of valuations. We are substantially higher than normal, if you will, or the average. But again, we're nowhere near the peaks. So if you look at the dot-com bubble, we're trading at around 25 times earnings. Right now, we're only at about 20.5 times earnings. So not quite there in terms of those types of stretch valuations that we typically see with a significant sell-off. So keep that in mind. But the one metric that I think that is very telling is the fact that US yields since January have plummeted from 150 basis points down to less than half of that at 60. Right now we're sitting at around 65 basis points. Now, if you think about it, the S&P 500 yields about almost 3 times that, almost 2% yield on the S&P 500. And when you factor in the dividend cutbacks in the energy sector, which is a relatively small percentage of the sector, and you add on to the fact that software and technology is becoming a much larger piece of the market cap of S&P 500, and you think about the big names that are now potentially going to generate some dividend yields, they become far more stable and far more reliable dividend yields. So if you look at from a yields perspective, and the S&P 500 is yielding 3 times what treasuries are yielding, it's actually quite inexpensive from that perspective, from respect to bonds and equities, because those are the two predominant asset classes that we have our assets in. And with bonds trading at relatively all-time lows, bond yields at all-time lows, and potentially going even further lower by the end of this year, beginning of next year, the futures markets are currently pricing in negative yields by April 2021. That is extremely supportive of equities if US government yields are going to be 0 or potentially negative. If the S&P 500 is still yielding 2% at that time, which at this point, we certainly do still continue to expect dividend cutbacks, but not to that type of extent. So by that measure, I think you're likely still going to see outflows from bonds into equities. And there's a substantially amount of capital within bonds that can flow into equities. And that's really part of the reasons why we're still continuing to see equities being supported and continue to trade at stretch valuations and even get stretched even further, is purely based on just yield. People need yield, and they're not getting it from bonds, they're not getting it from corporates, they're going to move towards equities in this particular case. So those are some of the reasons why we continue to believe that equities will continue to trade higher despite these stretch valuations. So with that, I want to point us to a few different charts here. Let's see if I can get my mouse to work. So let's take a look at reopening trends. So this is, again, some of the updates from Bank of America's credit card data. And what they've looked at are the credit card spending from states that are not open versus states that are open, like Georgia, Arizona, and Florida, versus New York, New Jersey, and Massachusetts. And the interesting thing is, number one, at the baseline, the total card spend is slightly better than what we saw here in the states that are not open. closer back to normal, if you will. There certainly are some bright spots, but those bright spots predominantly are in sectors that are not particularly big, like beauty salons. Beauty salons, a significant uptick compared to New York, New Jersey, and Massachusetts. Online retail a little lower as we expected because department stores are open, so there's a little bit more spending here on the department store level. Clothing also a little bit more spend, so a lot of this money that's shifted away from online shifting back to the physical stores. And then also groceries is declining because I'm guessing people are going back to restaurants a little bit more. So substantially more spending here in restaurant category versus states that are not open. But again, overall, not a huge uptick in terms of spending, certainly not near positive yet. So this is very early data. This is data that's still, I don't think we can reliably use this for investing just yet, but it gives you some sense for the type of uptick that we can expect when states do open their economies. Small uptick, but not significant. One of the interesting measures that I do want to take a look at is really this metric that has changed over the last few weeks, I would say substantially, as far as how comfortable are people going to be after states reopen their economy. So as far as the number of people that say they're very concerned about the coronavirus, that has been predominantly been on a downtrend, but we've seen a recent spike over the last few weeks higher. And one of the things that I want to point out here is, how long do you think the disruption is going to occur for travel, school, work, and public events? What's interesting is that for the people that say that they expect that this is going to impact them for the rest of the year and longer than a year, really has been growing substantially over the last 4 or 5 weeks. And the number of people who feel that it's just going to last for a few weeks or a few months has been steadily declining over the last few weeks. And this is in line with most of the things that we're seeing. If you look at Facebook's announcement yesterday that they were going to shift workers to working from home permanently. If you look at even my CNBC studio is likely going to be closed till at the end of summer, and that was something that we didn't necessarily expect. And I wouldn't be surprised if that gets pushed out to the end of the year. As far as getting back on a plane and feeling comfortable to travel, originally we were thinking July, August maybe, but at this point it might be much closer to the end of the year. And this is the type of data that I think is concerning for some certain stocks, like for example, some travel stocks. So these are some of the trends that are emerging that I think is important to pay attention to, depending on what type of investments you're currently making in the markets. Biotech. I want to take a look at biotech. We've been looking at the sector for quite some time. I pointed this out a couple of weeks ago, but biotech is basically on the verge of a massive double top breakout here that goes back to 2015 or so, when it made that 133 high or so. It's now, broke out above 123, which is the level that I pointed out quite a few weeks ago. Managed to break out above 123. It's consolidated for quite some time here within this 130, 135 range. And the question right now is whether or not we're going to get a breakout to the upside. If you do get that breakout, that's a pretty massive breakout. That's a 5-year breakout here on biotech. So it's definitely somewhat one of the sectors that I'm paying attention to, especially for those of you that are following which names are doing well as a result of having a coronavirus vaccine or a cure. This is really one of the sectors that have gotten a lot of press in the news. And I will say that I'm not a big fan of betting on specific biotech names. I much prefer looking at the whole sector as a whole, using an index here like IBB, as I was saying over the last couple of weeks. Another bright spot that has been coming to life is really industrials. Industrials managed to get back above its December 2018 lows, came back to retest that as support, and looks like it's starting to move a little higher. It's been trading within this range. It still hasn't quite broken out above the range here. I would like to see a breakout above 65, but a breakout above 65 would put it back up to the 72 and a half level, which coincides with roughly the 200-week moving average here on industrials. So it's definitely one of the sectors to keep an eye out for. It's one of the only sectors that was in the green yesterday. and starting to show some leadership. And I think part of it is also sparked from what we saw here in silver. And I pointed this out here last Friday as well, or maybe this was on Tuesday when I pointed it out. But silver, which is generally speaking a indicator of industrial demand, took off substantially earlier this week. Now, what's interesting is that we've had a bit of a pullback here in since that initial push higher. Then I think that this short-term pullback that we have is the opportunity to continue to go long if you missed that initial breakout, which many people did because it just simply gapped higher, and it just kept gapping higher for quite a few days. It's now pulling back a little. If you think that industrial demand is continuing to go higher, silver is an interesting leverage way, in my opinion, to play that bounce here in industrial demand. But as you can see, we're seeing a bit of a trend here between silver and industrials that are giving us a little bit of strength, showing us that as economies get back on their feet, that these are some of the sectors that are becoming bright spots. Target, I wanted to give everyone a bit of an update here on Target because this was the trade from CNBC. Now, Target had actually what I consider very good earnings, but sold off substantially since then. But I will say that what I quite like about Target now is that, you had this pretty choppy trading environment, but it's pulled back to its 20-day moving average. But I still like this stock for the long run, because if you look at the earnings announcement, they had a pretty good Q1, and they're looking very good for April of Q2. Very strong digital sales. This is a theme that we've been talking about for quite a bit here, both on Options Action as well as here at OptionsPlay, where we've seen this bifurcation within the retail space for stocks that have invested heavily in a digital strategy and an e-commerce strategy. And Target is really starting to see those rewards pay off in their investments in e-commerce, whether it's mobile delivery, whether it's grocery delivery, whether it's curbside pickup. That's seen substantial pickup in business since the start of the coronavirus, and that has not cannibalized their physical store sales, which actually has continued to grow despite the fact that a lot of their volume now is done digitally and online. So I like those things for Target, and I like the fact that the stock has pulled back to that 20-day moving average, which is usually a good entry for a long. So that's just a quick update here for Target. I will say that long-term thesis is decoupled from the short-term trade that we made here on Target. I'm looking for a short bounce here on Target and getting out of that trade. It didn't become a winner. It's basically flat at this point. So we'll see, but I still like this trade for the long term, especially if we think about investing in a post-COVID-19 world. Some of the other names that I want to point us to is really, how do you invest in this particular market, right? The market itself is not moving substantially. The S&P 500 really hasn't progressed much at all in about a month, but we're still seeing a lot of big movement from some of these stocks like Facebook stock that has made a new all-time high, which is a little surprising when we first saw it. But as you look at, if you look at Facebook's announcement yesterday, where they said they were going to shift a decent number of workers to permanently work from home, this shows you the huge shift in kind of how we're going to work going forward. And I think stocks like Facebook is going to potentially be a net beneficiary of this. A lot of different technology stocks are going to be a net beneficiary, and it really speaks to the real shift that's going to happen post COVID-19, that we are not going to commute as much, that stocks that like Zoom and stocks that support a work from home environment are going to see continued and massive support going forward. And Facebook being the first big player moving in this particular direction, I think you're going to see a lot more technology stocks follow in their footsteps, not just technology stocks, but also other industries that will follow in Facebook's footsteps. Now, Facebook did break out to a new all-time high above that 225 level. We might see a bit of a pullback here and then a continuation higher. Keep an eye out on that 225 level. If it can test that as support, I think that's a good risk to reward ratio for a long, because if you do get that pullback within to that, you simply cut your losses and move on to that trade. But that might be a good setup for a long trade here on Facebook. Other types of names that are supportive of us to, with the data that we're currently looking at, as far as feeling not as comfortable getting back to work and certainly shifting how we're going to work going forward. what's interesting is we've seen stocks like Etsy and eBay really take off in the post COVID-19 world. And Etsy, I wanted to point out, broke out above a major resistance level here around 73 or so, came back to retest that as support, which happens to coincide with the 20-day moving average. So I also think that from a risk to reward perspective, this is a great trade, because if you do get a pullback below that 20-day moving average, you can cut your losses pretty quickly if it gets back to around 68, when you still have about a $12, $13 move to the upside, risking roughly about $5, $6 to the downside. So that type of risk to reward I really like, especially with volatility pulling back, VIX below 30, you can start taking a look at buying options. You can start taking a look at buying a call spread here on a stock like Etsy. And that really allows you to take that directional view, but do so in a way with the smallest possible risk. Because right now, the risk of a pullback in the markets is certainly elevated. You have tensions in China. You have the potential of a second wave of coronavirus as some of these states reopen, despite still having despite having a significant number of cases of COVID. It's hard to say how that's going to play out. So there's still, I would say, significant risk of a pullback. So my preference on all of these plays is to use strategies like a call debit spread. So if we look at Etsy, just to give you a quick glimpse into that, the goal here is to try to play for that upside while risking the least amount of capital. So if we go out to July, I would be looking at something like buying a 75, maybe an $85 call spread, something along these lines, maybe a $90 call spread out to July, risking only $4.60. And if you think about $4.60 on a $74 stock, that's 6.2%. I'm only risking 6.2% of the underlying stock to bet that this stock's going to move higher. If you do get that significant pullback, no matter what happens, I'm only risking 6.2%. That's the type of risk reward ratio that I'm looking for. And that's the only options will be able to provide me that type of risk to reward. Another one that we're looking at, we did want to provide not just some bullish opportunities, because again, in this type of market, you do want to position a few short opportunities. So Goldman Sachs is one of the ones that we looked at, that we published today as a daily play. Financials remain one of the weakest sectors. That chart that I showed you before of 10-year yield speaks to why financials are weak, because they predominantly make their revenue on yield, and with yields so low, they're going to see their revenues continue to be compressed. M&A is almost non-existent, so the iBanking side is really not seeing much volume. Trading volumes also have been declining, and that's why we're quite bearish on a stock like Goldman Sachs. But we're doing this using options. We're buying options because, again, in this type of market environment, we want to risk the least amount of capital possible. And the only way to do that is by buying call spreads or put spreads. But there are still some names that we see are fairly weak. Hershey had a pretty big, massive double top here over the last few years. I'm sorry, over the last year or so. And it kind of has been trading within a range, but really broke out below this range here and is starting to move lower towards the 200-week moving average. On the daily chart, as you can see, got rejected at the 20-day moving average multiple times, started to make a brand new low, and I'm thinking that this stock may continue to move lower here. So that's an example of some of the weakness that we do see in the market. So there are opportunities on both sides here in the market, not just for longs, but also some selective shorts as well. But be very careful on shorts. You need to make sure that you take profits quickly. Same thing here on Procter & Gamble. Staples really not being, the defensive plays. Staples, utilities, not performing very well. Procter & Gamble making a new low here yesterday. If it breaks below that 110 level, I think we'd certainly see some further down moves to the downside here in Procter & Gamble. You have the 20-day moving average coming down as resistance, so which provides you a small stop. If you have to get stopped out on that particular trade, you want to get out of this trade if the stock moves significantly above the 20-day moving average. And lastly, stocks like Team. These are names that are going to continue to benefit from a completely new shift in terms of how we work. This stock made a massive breakout around 155. It had an initial pullback, and now we're getting a second pullback here. And I think that might be an opportunity for a long here in a name like Team. So there's plenty of opportunities here in these, I would say, high-tech low yield type stocks, high beta stocks. These are the types of names that you want to play at this moment. These are the names that are likely going to have that big move to the upside, which justify buying premium, buying calls spreads. On a lot of stocks that you think are relatively neutral or big cap stocks, you may not see those big moves. So you want to position more for the riskier stocks at the moment rather than the less riskier stocks. That's really what's driving the market right now. And you want to utilize options to trade that. So let's just take a look at this. The market's just opened. We are just flat here on the day, and that's predominantly what we're seeing. And again, my base case is you might get a little bit of a pullback here, but likely you're going to at some point retest 300 and 302. So with that, I hope that this was useful in helping you understand what research we're currently looking at, what flows we're currently looking at, how do you want to look at the markets, whether it's cheap or expensive, and have a thesis for both, because there certainly can, in my opinion, be a case made for both sides. So don't just be skewed towards things are really expensive, let me short the markets. There are some reasons why this market, I think, can continue higher, even above 302. So with that, I hope that you guys find this useful. And before I sign off here, I just want to let people know, for us to continue doing this, I hope that you consider supporting us and becoming a member. This allows us to continue to build out our platform, build out education, do these Tuesday and Friday morning outlooks, and provide you with this type of research so that you are informed in your trading decision process. And I just sent you the link here in the chat window if you have not become a member yet. So thank you so much. We will send out the recording to you guys here in a little bit. I hope you guys have a great trading day and happy Friday, and I'll see you guys on CNBC this afternoon.